April 2nd, Trump Tariff Day, aka Liberation Day, might flip the global economy on its head, and no one actually knows how it will play out. But what if I told you Liberation Day isn't just about tariffs? Trump's gearing up to slam $1.5 trillion worth of imports with sweeping 20 to 25% tariffs. Canada, Mexico, China, all on the chopping block. Allies are retaliating, markets are cracking, tech is selling off, and global uncertainty is peaking. Picture it, massive taxes landing all at once, allies blindsided, and supply chains unraveling. But is Trump truly going to pull the trigger, or is he up to something else? Is this just Trump being Trump, or is it a high-stakes, calculated strategy designed to break the Fed's will? Today, we're going to discuss the difficulty that the Fed is in and how, ever so slightly, their hand is being forced. More importantly, we'll discuss how when central banks are cornered, hard assets like gold and Bitcoin tend to shine. So could April 2nd be the chaos before the pivots? Could we be staring down a forced Federal Reserve reversal? One that sends gold and Bitcoin flying while legacy systems stumbles? Let's unpack what's coming and why this may be the most important market week of the year. Yesterday, we covered the Trump administration's play to levy reciprocal tariffs on top of reciprocal tariffs. Well, today he came out and gave us the rug. And by rug, I mean blanket. That's right, blanket tariffs. Using the words broader and higher, Trump announced a possible 20% tariff on all trading partners across the board, despite comments in recent weeks that he might be more generous. Today, he said tariffs could apply to essentially all trading partners. And the rest of the world isn't exactly rolling out the red carpet, but they're reciprocal tariffs. I mean, come on, it makes sense. It's just, to me, this is just common sense. I mean, am I the only one who's crazy here? Like, it would just make sense that if you and I were trading something together and you impose some sort of rule on me, don't you think it would be fair that I impose the same rule back on you? And let's say the first year I didn't impose the rule because, I don't know, maybe I had some advantage or something. But then the second year I decided to reciprocate and impose the same rule back on you that you still had levied on me. Like, I understand that this is not good for our bags, right? But I don't understand why everyone is so blown away. Unless it's just people who are pissed off about their bags. And then I understand, right? I understand. So in response to Trump's tariff threats, China, Japan, and South Korea announced a coordinated retaliation ahead of April 2nd, making their first economic dialogue in 5 years. Who would have thought that Trump would be the historical force that finally brought these sometimes adversaries together? The three nations called for a renewed focus on implementing the Regional Comprehensive Economic Partnership, a regional trade framework that includes 15 Asia-Pacific countries. And one of the things that they might be collaborating on is semiconductor materials. I don't know if you know this, but this is one of the US's most strategic imports. This is no simple spat. It's a full-blown realignment of global trade relations. According to an analysis conducted by Kobesi Letter, if $1.3 trillion worth of commerce gets hit with new taxes, we could lose 100 basis points of GDP. That kind of blanket assault on import doesn't just nudge inflation. It can paralyze business investment, freeze hiring, and slam consumer spending. Markets still seem to be underpricing the impact. But once these tariffs go live, the supply chain whiplash could create some real difficulties for the Fed. When you hammer your allies with tariffs, you can't expect them to keep piling into US treasuries. Nations like Mexico, Japan, and South Korea are already fuming about the new trade taxes, now have more reason to diversify their holdings. They're looking to gold as a hedge against a potentially weaponized dollar. Over the past month, gold's been steadily climbing every time a new tariff rumor hits. This is classic flight to safety behavior, reminiscent of the 1970s, when global uncertainties push gold to new all-time highs. These reciprocal taxes can be seen as hostile moves prompting countries to reduce their exposure to US debt. If major holders of treasuries pivot away from the greenback, global demand for dollars could wane further, undermining confidence in the dollar, especially if it's perceived as politicized and raising questions about its long-term status as a leading reserve currency. Bottom line, if the US keeps isolating itself with broad tariffs, expect foreign governments to diversify reserves into gold or potentially our bags, cryptocurrencies. The Fed can't print international goodwill, so every new tariff risk may accelerate that search for alternatives. As we discussed yesterday, the word on the street is we are headed for stagflation. Tariffs on the EU alone, about $600 billion in imports, could slash US GDP by 70 basis points and crank up inflation by 40 basis points. For a $25 trillion economy, shaving off 70 basis points is no small thing. That's billions of dollars of lost output. Meanwhile, an extra 40 basis points of inflation is like throwing fuel on the fire just as consumers are starting to feel relief. Goldman's stagflation scenario basket is already soaring. This is a basket of stocks that would theoretically thrive in such a scenario. Well, it's thriving. The market is effectively betting that we're marching into the 1970s again, where supply shocks hammered growth while prices ran wild. If so, the Fed is stuck. Raise rates and risk deeper recession, or cut rates and watch inflation break the dam. That's a pure lose-lose trap. But here's the kicker. If these tariffs start piling up from multiple fronts, EU, Mexico, Asia, it might supercharge inflation beyond what the Fed can handle before they even get around to those cuts. It's like pushing on a balloon. No matter how you press it, something else pops out. Amid all of this doom and gloom, there's an angle we can't ignore. President Trump could be betting that things get so bad, the Fed has no choice but to step in. Think about it. By letting the economic outlook deteriorate via tariffs or standoffs, Trump might force the Fed to blink first, cutting rates to prevent a full-blown crisis. It's counterintuitive, but historically, the Fed often waits until the economy or markets are about to break before acting. It's the old joke on Wall Street. The Fed doesn't cut rates until something snaps. Tariff escalations and a slowdown in GDP. These are catalysts that might snap the economy. And ironically, that's when the Fed steps in with easier policy, fueling a pump in markets. Right now, markets are already pricing in multiple rate cuts. Some say 3 or more, some say less, which suggests the market expects an eventual pivot. That suggests investors think the Fed will cave before Trump backs down. In a sense, if Trump pushes harder on tariffs, the Fed might have to slash rates faster to contain the fallout. It's three-dimensional chess. I know this sounds crazy, but if the Fed starts slashing rates hard, cheap money could flood right back into stocks, gold, and crypto. Just like we saw in 2008 and 2009, when massive liquidity injections supercharge risk assets. So while the headlines scream doom and gloom, political pressure and Fed hesitation could actually collide into a massive tailwind for risk assets. Because if history is any guide, the more dire the crisis, the more the Fed prints. And when that happens, gold and Bitcoin tend to benefit. And now for the twist. President Trump's got his hands all over crypto. Meme coins, World Liberty financial stable coins, and DeFi sound bullish at a glance, right? But according to top Republicans, this is creating a massive conflict of interest on Capitol Hill. House Financial Services Chair French Hill claims it's more complicated to push stablecoin bills when the president himself is deeply invested. Some GOP members worry about the optics. How do you pass a law that directly benefits or hinders the very coins the president might be profiting from? Meanwhile, the White House can lean on certain Republicans to tweak bills so the entire process turns murky. And just like that, if you thought the Trump family was done at stablecoins or DeFi, well, think again. They've teamed up with Hut 8 to launch something called American Bitcoin. The goal? To build an exahash scale mining enterprise that could, in theory, become a major Bitcoin producer while possibly adding to the existing strategic Bitcoin reserve chatter. Is it just PR? Possibly. But if it's legitimate, it shows how deeply entrenched US politics have become in crypto. Whether that's bullish long-term remains to be seen. But from a pure market standpoint, Trump endorses more Bitcoin mining is exactly the kind of headline that could lure even more eyeballs and big money toward crypto. Even with the political noise, we see bullish news slowly emerging. On Capitol Hill, Congress is about to tackle crypto market structure. A hearing set for April 9th is entitled American Innovation and the Future of Digital Assets, aligning US security laws for the digital age. With a name like that, it can only mean progress, right? It will mark the first public effort by the 119th Congress to establish rules for how the crypto industry will operate in the US. Think about it. A dedicated hearing that could set the stage for US regulations on exchanges, DeFi, and digital assets. Sure, it's not a done deal. If anything, the president's personal crypto involvement complicates it, but this is still a giant step. If the subcommittee can hammer out a blueprint for how tokens and blockchains operate under US securities laws, we could see institutional money feel a lot more comfortable stepping in. But hey, that also means the SEC could tighten the screws if they decide half of these tokens are unregistered securities. Either way, the fact that Washington is finally focusing on real market structure for crypto, that's bullish in the sense that clarity, good or bad, beats the murky gray zone we've had for years. And then we have Circle, the issuer of USDC. And yep, full disclosure, I'm an investor in Circle. Anyway, they're preparing for an IPO as soon as late April, targeting a valuation between $4 to $5 billion. Sorry, I'm doing a little celebration dance right now. Anyway, let that sink in. A stablecoin giant about to go public. Think about how big that is for institutional credibility. A publicly traded stablecoin provider means your everyday Wall Street analysts can value, invest in, or short a stablecoin business. And these are very profitable businesses. Add in the fact that USDC's pegged to the dollar, and you start seeing real synergy with banks, brokerages, and money managers. Sure, the last SPAC attempt flopped in 2021, but this time Circle's got fresh momentum and a friendlier regulatory environment. If Circle's IPO is successful, expect more big players to pivot or double down on stablecoins. In a world where stables might also face fresh regulations from the House or Senate, Circle going public is huge statement that crypto's not going anywhere. Let's do this. Larry Fink, the CEO of BlackRock, is out there making waves with two big claims. In his annual letter to shareholders, Fink said, first, tokenization is the future. He says every stock, bond, and asset could move on-chain for faster settlement and improved transparency. This is what I've been saying forever. In that same letter, he also warned if the US doesn't fix its debt, Bitcoin might dethrone the dollar as a world reserve currency. Whew! Let that sink in again. Wow. This is the head of the world's largest asset manager basically warning that America's infinite money printer could push investors to BTC. Meanwhile, he's actively praising DeFi's ability to transform finance. For a traditional finance titan to say that, it's literally 180 degrees from a few years ago. So while inflation may be roaring, and the Fed is concerned, if major capital views crypto as a next safe haven that marks a massive shift in mainstream psychology. Here's the punchline. Despite all the noise, tariffs, potential stagflation, regulation battles, Bitcoin continues leading the major asset classes since election day, outrunning gold, the S&P, and NASDAQ. Why? Maybe markets see BTC as a hedge against chaos. Maybe it's the unstoppable narrative. Or maybe it's just a cycle. Whatever the reason, when the macro is this ugly, money historically flows to gold and increasingly digital gold, i.e. Bitcoin. So even if we're stuck in a wait and see moment, BTC is quietly reminding everyone that it tends to survive and even thrive in times of massive uncertainty. And that alone is a big bullish sign for the crypto faithful. So where does that leave us? Tariffs escalate, we get trade wars. Supply chain shocks, higher inflation, and stagflation. The Fed tries to fight it, but can't. Either they cut rates too early or too late. Meanwhile, crypto sees bullish catalysts, Circle's IPO, Larry Fink championing Bitcoin, and new Trump-backed mining ventures. If stablecoin and market structure bills pass, we might see a fresh wave of capital flood into crypto, especially if the mainstream economy looks precarious. This is a classic scenario. When the old system breaks, a new one rises. I'll put it bluntly. The Fed is cornered. Tariffs could blast inflation higher, or we tumble into a recession. Allies might ditch the dollar, and somehow the Trump family invests deeper in crypto while Congress tries to finalize stablecoin and cryptocurrency laws. Are we watching the final meltdown of post-2008 experiments, or the beginning of a massive pivot that sets gold and Bitcoin roaring? Let me know in the comments, guys. Do you think the Fed or the White House can pull a rabbit out of a hat? Or are we heading full speed to stagflation? If you found value in this breakdown, guys, do me a favor, smash that like button, share this video with all your friends, someone that could use it, and subscribe for more macro and crypto coverage. I'll catch you guys in the next one. See ya.